Good morning, everybody. So it's now we're rolling into 2024. And if you've been watching the weekly Altos data videos, you'll know that the data seems to make me pretty optimistic. And optimistic when I talk about optimistic for housing in 2024, I'm talking about growth in the number of sales, the number of transactions, and signals of having more inventory for selection for buyers, and at the same time, prices holding up. So if you have buyers on the sidelines who are waiting for the market to crash so they can swoop in and find a bargain, maybe optimistic isn't the right term for those folks. But for a healthy market, for a return to growth in housing, the signals are pretty optimistic. They're not huge bullish. They're not roaring. There's not a boom market like we had a few years ago, of course, but they're optimistic. And it's a shift from a very slow year last year. And it's a notable shift. It's a small shift. And so we're going to dive in and talk about those things today. Uh, as a little intro, we're here for the data today. We're talking about the data. We're talking about the housing market, the national market, and the local. We'll do some of the local markets. If you're new to Altos, Altos is not just about the data. Altos is about helping you communicate with the data to your buyers and sellers, to people who need to understand what's happening in housing right now. So if you are unfamiliar with Altos and how the data can improve your business, I want to encourage you to book a demo with our team. Jeff from the Altos team is in the chat right now. Lael from the Altos team is in the chat right now. There'll be a link in the chat where you can click through to go book a demo with the team and take a look at the Altos platform, how we turn the data into your communication to your buyers and sellers right now. I'll show you a little bit of it, but in this webinar today, we're really spending time on the data, but I want you to know about building your market reports, your local market reports, doing your analytics for your markets, for your buyers and sellers, helping them understand if they need to take action quickly, if they're sitting on the sidelines and waiting for some bargains. Are those bargains coming? That's what you're using the data for in your local markets and getting it from you to your clients, your buyers and sellers right now. And so I really want to encourage you to click that link. There's a link in the chat, I'm sure, to go book a demo with our team if you haven't spent the time to explore how to use Altos in your business. Okay, so that's the ad. But let's talk about the big ideas today. As I pointed out, and if you've been paying attention to the work lately, the data lately, um, we really see the real estate market growing in 2024. There are signals about what's happening already, what's already shifting, and the leading indicators we can already see for the rest of 2024. We're talking about prices and inventory and sales volume, the pending sales. We've got a bunch of data in there that we're already seeing. We'll spend some time with the local markets today. And as always, I try to help each of the data points when you are communicating with buyers and sellers this spring, thinking about what their needs are, what their objections are, what their fears are, and using the data to communicate with them to help them make smart decisions. All right. As I'm talking about the data, as always, if you're not familiar, we have a really great free ebook where you can use how to read the data that I'm talking about. There's scripts, there's strategies for when to talk about it, how much to say, what all of the ways to understand the data, using the market data to build your business. So there's a link in the chat to go download that ebook if you don't have it already. I highly recommend that, and you can see the data I'm talking about today. All right, let's start with the data. So there are currently just over 505,000 single-family homes on the market across the U.S. That's 7% more than last year at this time. So a little bit of growth in inventory. This is like the 10-year chart here, and you can see how over the decade of lower mortgage rates, we had available inventory, supply of homes that you could buy, shrinking basically every year. And you can see during the pandemic, inventory dropped dramatically to the low point in the first quarter of 2 years ago, when we also had our lowest mortgage rates, and then the spike back up. So inventory grew pretty quickly in 2022, the second half. Last year, we had a pretty strong first quarter where inventory fell, but then second half of the year, as mortgage rates started rising, inventory started building again. And we're now in a point where we are 7% more homes on the market than last year at this time. And each week, that gap is widening a little bit. So last week it was 6%, and the week before that it was 4.5% more. So each week it's growing, and those trends look persistent to me. That means that it looks like we will continue to grow over last year. The big caveat to that statement is mortgage rates. If mortgage rates rise from here, they're at 6.7 or something today. If they rise from here over 7.5, you'll see a dramatic slowing of the market, and you'll see inventory climb more quickly. If we see rates fall, and we continue to have people who project mortgage rates continue to project mortgage rates to fall. A year ago, they were projecting that, and rates did not fall. So I don't project mortgage rates. So it is, if they fall, especially they fall under 6 into the 5s, then you'll see an acceleration of demand, and we will see less inventory. So people will buy more, will hold more, and the available inventory, available supply will fall from here. I've got a projection of what that looks like. But in general, as of right now, the trends are relatively positive. This means slightly more selection for buyers. It means there's no sign of any flood of inventory that might get us out of balance and cause like price crashes. So it's slightly optimistic, which is the sort of message of the day, slightly optimistic for the year. And I talk about how inventory is related to mortgage rates. And the rule of thumb is that when rates are falling, inventory falls. When rates are climbing, inventory climbs. And what we've done here is the green shaded parts are when inventory is low, or when rates are low and falling. The red shaded parts are when rates are rising. And you can see how the inventory line, for example, in 2018 to 2019, rates rose in 2018. By January 2019, we had the first year of higher inventory of the whole decade, because that was really the only year that rates rose substantially in the year. Then suddenly in 2020, right at the beginning of pandemic, 4 years ago, rates fell dramatically. As mortgage rates fell dramatically, inventory fell dramatically. Last year, rates spiked from 3% to 7%, and inventory spiked. This year, inventory started off with its low, and then at the far right end of the chart over here, there is the second half of the year, rates rose, culminated at 8% or over 8% in November, and inventory rose all year long till we finally had more inventory than last year. So now we're at 7% more than last year. And at this point, it looks like we're not going to get back to last year's April low, and we will start marching up unless mortgage rates shift into a persistent fall again. And if they do, then we're going to watch what happens is rates fall. It's more affordable to hold real estate. Therefore, more of us hold real estate. We buy more, we sell fewer when it's cheaper to hold. And so the available inventory falls when rates fall. That's counterintuitive to a lot of people's expectations, where the expectations are conventional wisdom is that if rates fall this year, we'll finally get more inventory. But it's actually the opposite that's true. And what we're looking for to get back to the old levels of inventory of 2019, 17, like in January, in 2015, there were 1.2 million homes on the market, more than twice as many homes on the market as there are now. And the way we get back there, even close to that, is higher rates for longer, multiple years. Let's look at the state level. Inventory is rising across the country a little bit, 7% more, but it's not true in all states. So in this view, the red states are where inventory is climbing over last year, and the blue states are where inventory is below last year's level. In almost all cases, they're getting the whole thing is shifting up. So, for example, last month, California, it was I think 19% fewer homes on the market than a year before. Now it's 13%. So it looks like we're marching forward to inventory gains more across the country. The Texas and Florida, the South markets have significantly more inventory than a year ago. But, and I'll show you this later, like some of the Northeast are still at pandemic lows. Like Boston is still at the lows of inventory from during the pandemic. So it is not at all the same across the country. Uh, and in fact, Vegas has dramatically fewer homes than were on the market last year. And I think that is a function of California migration, affordability in Vegas, where like there's still a lot of people who can snap up homes in Las Vegas. But it's really fascinating that Vegas, Phoenix, Boise, those markets actually inventory gained dramatically a year ago, actually 2 years ago now, when rates started rising. Those markets slowed fast very quickly. Many of them recovered last year. The Western US markets recovered last year. And that's why we have lower inventory in those. But it's really fascinating. South, Central, more inventory. West and Northeast, less inventory than a year ago. And so let's look at the why this is. So we have new listings are starting to be slightly more than a year ago. 5% more new listings this week than a year ago. Each line in this busy chart, each line is a year. So each week has more listings or less listings. The gray lines are where it used to be. Those are years past. The light red line is last year. And so if you look at the left end of the chart here, the 2024 is starting to be each week a little bit higher, more sellers. It's just starting to come back in than last year. And what's happening here is, the defining characteristic of the 2023 housing market was how few home sellers there were. Few people wanted to sell their homes. And you can see that the light red line was lower all year long, like record low, record few sellers all year long. Then at the right end of the chart, each week it started to have more sellers than the previous year. And 2024 is starting the same way, back at the left end, the January side of the chart here. And so we had one of the things that kept a lid on home sales last year was the fact that there were not enough homes for sale. So had what I call a supply constrained market. And each week now we have slightly more home sellers, and therefore we have the opportunity for more sales. So we have sales growth starting to happen. If rates were to fall dramatically, what you'll probably see is you see more new listings, but those get gobbled up quickly. So the available inventory will shrink. So if rates fall, buyers who are sitting on the sidelines now, hoping for a better deal, what they're going to find is a tighter supply and more buyer competition. So it is not a slam dunk to just wait and see if rates fall, because what they're going to run into is less selection and more competition at the same time. There's a lot of people who are in that same boat, and it's understandable. It is not it is like understandable. Affordability is a big deal. Rates are higher, payments are higher, and so if payments can fall, that therefore we have an affordability opportunity. But there's a lot of people waiting for that, and so we can see that with the new listing. So the good news is that we can see each week sellers testing the market, feeling a little more. And these are sellers who, we have natural rates of people who need to move. There's all the 5 Ds, the the divorce and diapers and all of the different life events that cause that. And so sometimes people aren't going to hold on to their 3% mortgage forever, and they're going to move. And each year that we have rates higher for longer, more and more people that are going to get that. So that's what we can see easing in there. One thing to notice about the new listings is that there is no flood of listings, no flood of sellers hitting the market. And that is because that is notable. It's important because you can see the gray lines how in the January side of the chart here, the gray lines shot up more quickly in recent years, or more sellers, like maybe 50, 60,000, where we've only 20 or only 40,000 that hit the market this week. Um, and that's telling us that, like, we're not going to get to 1 million homes on the market or a big flood of homes. And it's also telling us we're not going to get in an imbalance with buyers and sellers, where suddenly there's price corrections heading down because there's only a little bit more supply. When we look at the new listings, there is, in the pandemic, we had this defining characteristic of the pandemic, which was what we called the immediate sales. So these are homes that get listed and then would take offers, within hours or a couple of days, and you have the bidding wars, and they'd go into contract. And so they essentially spent zero time on the active market. You see these now marketed. There's coming soon homes. There's thousands of homes around the country that are being marketed as coming soon. They're not actually on the market, but then when they get listed, they can take offers right away. And so they essentially spend zero time on the market. In this chart, the height of each bar is the number of new listings that happen each week, and the light portion of the bar are the immediate sales. And you can see in the middle of the chart during the pandemic, the immediate sales is a big chunk, like a third of homes were going into contract immediately after listing. Last year, way fewer. The bars are shorter, fewer sellers. And what we can see right now at the far right end of the chart is that there are more sellers each week, and the immediate sales are also a little bit bigger each week. And that is saying that there's those buyers who are there who more than last year. There's sellers who are there, and the buyers are there who are taking up the slack. So that's why there's not dramatic increase in inventory. Just a little bit, just easing a little bit. And so these are what I would call the optimistic signs for the housing market. We can see more sellers, and we can see the buyers there ready to pick up those transactions. So how does it play into the projection, the forecast of inventory for the year? Each line in this chart is a year. You start the year at the lowest level of inventory. It grows it through the second quarter. Usually inventory would peak in, say, August or September. Last year, because rates started rising dramatically in September, inventory didn't peak until November, late November, before it started falling back down for the year. And you can see the dotted line is where we project the curve for all of 2024. That shows inventory growth over last year. It shows each week, as I mentioned, the gap between this year and last year is growing a little bit. And so we're projecting that to continue through the into the second quarter and then start. This assumes that mortgage rates stay roughly the same, roughly in the mid to upper sixes. As I mentioned, if rates were to fall dramatically in the first and second quarter, you're going to see this projection line ratchet down each week, because we'll be buying more homes, taking them off the market, and each week will start shrinking. And in fact, last year, rates were falling pretty quickly in that first quarter, and inventory didn't hit its bottom until April or May, and then start climbing. So that's entirely possible in a decreasing rate environment. They fell off their November peak, but they've been roughly flat or even up the last month. So I call that, we roughly flat for as we're looking this spring. So higher rates that are roughly flat is leading to slight inventory growth. And that's where this curve comes out. If we were to, we've been projecting, the powers that be have been projecting recession for 2 years. It hasn't hit yet. People are still employed. There was like real strong employment report this morning. So that shows that um, that like uh, if a recession comes, a big job loss recession comes, that will hit demand. And so you could imagine later in the year, if a recession comes, that it would that would ratchet this projection higher. The big inventory of a recession, like distressed inventory, people lost their job for a long time, that kind of inventory is really another year out. So we're really already looking at mid 2025 if a big recession hits soon. And that before we would get some like, wave of distressed inventory. It's time has marched that forward, and we've been talking about that phenomenon for a long time because recession has been possible for a long time. It hasn't hit yet, and so what this tells us is that this is where we're looking at in roughly the stable, same conditions, and it could adjust up or down from here. Let's move into the sales side and the pendings. This is a chart of the total homes with contracts pending. So these are sales that are not yet complete. The contracts are pending. And the height of the bar is the number of homes that are in contract at any given time. The light portion of the bar are the new pendings, the new contracts in that week. And I've drawn the lines here, the dotted line to see this current week's level compared to where we were last year. So we have 251,000 total contracts pending. This is single family homes in this data. And last year there were 238,000. So we have shifted to growth in home sales, number of home sales that are in process. And these will close in 30 or 45 days out. And we can start to see growth over last year. That shows us that we are past the bottom of the recession, the housing recession of the slowest sales. And this housing recession didn't really have price reduction, had prices drop. It's really the number of sales that slowed way down and prices stayed roughly the same. But we're past the bottom of that and expanding each week. We can also see that the new pendings this week are also 5% more than last year, the second week of January. So that continues. The new sales each week continues to outpace the sales last week. And so what we have is more inventory, more sellers each week, more new listings. Inventory is growing each week. We also have growth in purchases, right? We've been in a supply constrained market. And so when we increase the supply, we also give room to increase the number of transactions. So that's optimistic. It's still off a very low number. So the total number of sales is still going to be low this year, but we could see 10 or 15% gains in the number of home sales. So if last year 2023 finished at, call it 4 million home sales, you could see 4.5 million, 4.6 million for 2024. Looks like it could be in the data already. And when I say in the data already, there are homes in contract. They're going to close in the first quarter. We can see the listings starting. We can see the new contracts building each week. We can already see that sales momentum really for a lot of the year that's already starting to hit the market. And that trend seems durable to me. This is a view that I found really useful for myself. And when trying to understand, are we past the bottom of the recession of housing, the number of sales? And what we're doing is, what I'm charting is the difference between sales this year versus last year. And you can see, a year ago, we were running 40% fewer sales in a given week than the year prior. So last year we were comparing to peak pandemic frenzy, and it was way fewer. Sales climbed with 20%, 15% fewer sales all year long. And then just starting in like November and December, now we are showing gains. So above the dotted line means the market is expanding. Slight gains each week from the year prior. So this week, 5% more new sales than the year prior. Last week was like 20% more in that first week of January. There's a little noise. It bounces a little bit in there, but this really says to me, and you can see the slope of that line says to me that we're going to be above the sales growth all year. We're going to end up with more transactions, more inventory, more transactions, and good price stability in 2024. The days on market is climbing a little bit. And so currently 69 days, just over 2 months is just a little bit, a few days longer than last year. It is still faster than pre-pandemic times. This is a chart just the last couple of years, but you can really see where you can see where where we are compared, and we're almost to the peak time because in first quarter we get fresh inventory, we get more transactions, and so days on market starts falling again pretty rapidly. You can compare to, the peak coming out of the 22 first part of 22, the pandemic frenzy, 30 days on market for any home across the country before it slowed way down. So that's where we are this year. And as homes stay a little bit longer on the market, that means inventory builds a little bit more too. All right, let's switch to pricing. The median price of single-family homes in the U.S. is $420,000 this week. That's a 3% gain over last year. So the second half of the year was really zeroed in on our home price gains over last year. We could see, if you've been watching the videos or these webinars over the last few months, we've been saying this is exactly where it was going to land, and that's exactly where it landed. There's no signal anywhere in the data of any surge in home prices for the year. There is likewise no signal anywhere in the data of any crash in home prices anywhere in the year. So, like I said, I've mentioned that, there are buyers out there who are waiting for bargains. They're like, I'm going to wait until some bargain happens. And the question is, how long are you going to wait? There's no signal in any of the price data of home prices crashing down. Maybe you get lucky and mortgage rates drop, and you can get cheaper payments, and maybe you time the market that way. But what we do here in using the leading indicators here, so the median price of the new listings, and I've been talking about how we have slightly more new listings right now. We can use the bright red line here. The median price of the new listings this week was $390,000. That is like 5-6% more than last year at this time. And so that shows us continued slight price gains for the year, home price appreciation for the year. And what we do is in that bright red line at the right end of the chart is these next few weeks, like to see how steeply that climbs. And what happens is it's a really great example of what they call wisdom of the crowds. The crowds this time are all the sellers and all the listing agents. And all of these folks who are thinking about listing the house in January, they are looking around and they know how many offers were down the street. They know how many people are in the open home. They know exactly where to price the home. In aggregate, they know exactly where to price the homes. Any given home may be over or underpriced, but in general, they know exactly pricing the homes where they're going to sell. And so what that tells us is when demand is sufficient, then the price of the new listings gets ratcheted up the next week. And you can really see this dynamic in January of 22, so 2 years ago, sort of in the middle of the chart here, the bright red line, see how it skyrocketed in that first quarter because those sellers knew exactly what the market conditions were underway. They had multi offers, they had bidding wars, and so each week the new listings were like, well, I'm pricing higher than the people last week, and so that bright red line jumped very, very quickly. it also started dropping very, very quickly after May of 22. So this year we're seeing a slower slope, a slower upswing in prices, but it looks very similar to the pattern from last year, which implies 3 to 5% home price gains for 2024. Uh, Homes get listed now, they get an offer in the first quarter, they close in the second quarter. Like, you have a lot of visibility in these first few weeks of the year about what's going to happen to home prices for the whole year. Um, we can see that dramatic change in mortgage rates will impact the new listings and the overall price and demand. Things can impact it very quickly. And as I've said, consumers are more sensitive to changes in mortgage rates than to the absolute levels. And when I say that, I mean that we're now at 6.7% mortgage rates, and home prices, there are slightly more sellers. There are slightly more buyers. Their prices are slightly higher. And it's that stability that is allowing those sales to start happening more. If rates jump to 8%, now we have instability. That's that change in rates, and that'll put the brakes on very quickly. It'll put the brakes on the new listings. It'll put the brakes on the pendings. That we can see it in the pendings data. We'll see it in the price reductions data, which I'll show you in a second. We can see it very quickly in those, and then we'll see the market numbers start to ratchet down. So, assuming we have good stability in prices in mortgage rates, we can therefore see this growth, this slow, steady, slightly optimistic growth for 2024. And if I look at that bright red line up from last chart, the price of the new listings by year, you can see sort of each year how home prices ratchet up each year. And the big lines here from like 2020 is when we had big gains in the second half of the year. 2021 was elevated. And then the bright red line last year, we had year-over-year price declines, the bright red line under that light run, until the end of the year, and then we started moving up above. And so we could see this at the last quarter, home prices, the new listings were pricing above the year prior, and that's how we knew that there was enough demand that the year would end with home price gains. This year we're starting above last year, so home prices are up. They're up a little bit each year, and we're going to watch that. But I suspect that we're going to peak at a new high in May with the new listings, and then curve back down for the second half of the year. Again, the signals here are there's no signals in the data of any imbalance in supply and demand, which would imply home prices falling. There's no signal in the data of like people distressed about the economy and therefore not buying homes and therefore home prices falling. Like, there's no signal anywhere in the data of those things. So that's what we can see across the board. All right, let's look at the pending sales prices. So the two lines here over the last couple of years, 3 years, is the price of all the homes that are in contract and the ones that go into contract each week. Home prices are 4 to 6% over last year at this time. The median price of the homes in contract are $380,000. That, like I said, is 6% over last year. This week, the new sales came in at $365,000. So that's a 4% increase over the last year. And those are over 2023 numbers. And so we'll start to see the new listings the new pendings, the new sales start to climb. So this week, with the data that finishes tomorrow and reports next Monday, will be the first really of the beginning of the sales of the new year. And so we'll see pending home sales numbers tick up. We'll see the prices probably tick up as well. We can start to see the spring curve of new buying. But all in all, what it points us is another way to measure home prices, and it's another way that shows us we're consistently over last year at this time, and consistently but no like boom markets anywhere in the data either. And then let's finish on the pricing investigation, looking um, at the price reduction. So this is the percentage of homes on the market that have had price reductions in the last since the original list price, so last few months. The right now there are 32.2% of the homes on the market have had price reductions. That's right in the middle of the normal range. So each line here in this chart is a year, and you get in the spring you get the best new inventory, you get most buyers, so fewer sellers need to cut their price. Then as you get into the second quarter, we start to get the end of summer is at hand, and you can start to see that if you haven't had offers, now you start doing price cuts. So in the second quarter, price cuts start climbing, and they usually peak in the second half of the year, usually around October. And then the inventory starts to turn over. Any real stale inventory gets withdrawn, and it falls back down for the holidays to reset the new year. So that's the normal cycle for each year. Last year, actually the last 2 years, so 2022 and 2023, we had rising mortgage rates starting in September. So this is last year, but this is 2022. We had our peak price cuts at 43% of the market had taken a price cut. So nearly half of the homes on the market at the end of 2022 had taken a price cut. And the way you read this is that, so that was November 2022. Those were homes on the market there. They finally get offers in maybe January or February. The deals close in March or April. And if you look at the headline home price numbers, like the things like the Case-Shiller or the NAR data, those were reporting annual home price declines in April of this year, April of 23. The price cuts that we could see were November. They were 6 months earlier. We could see the peak of the price cuts. So that when we saw that price cuts were in November at their peak, that told us that the following April, 6 months later, the headlines were going to report annual home price declines. What happened was then with the bright red line there for the 2023 curve, starting in January, February, March, by April, when those headlines were reporting annual prices down, our price cuts, the active market, was now back into the normal range. And that told us that we were going to be, by the end of the year, we would have home price appreciation again. So we really have a nice 6-month lead time looking at the price cuts for understanding what's going to happen to the sales that close in the future. Houses on the market now, if it doesn't get an offer in January, it does a price cut in February, it gets an offer in March, that closes in April and May. You can see well out into the future with the price cuts data right now. And what it shows us right now, fewer price cuts than last year at this time. It's declining. It's in the normal range. There's nothing in the active market data that implies home prices are going to fall in the coming year. There's nothing there. Even if you have hypothesis about recessions or job losses or inflations or like a real bearish view on the economy, there's nothing in the housing data that shows that in 2024 we're going to have a price declines. Let's look at that. I like to look at the Altos data. Let's switch to the Altos platform. We're going to look at the local data of the price reductions. And this is the Altos platform. And at the beginning of the webinar, I mentioned that if you are not familiar with Altos and you're just here looking at the data, but you need to communicate with buyers and sellers right now, I recommend that you go book a demo with our team. We can look at your local data, but also we can talk about how do you set up your email so that these market reports that are your market reports go to your clients so that they can buy and sell from you right now, that they can make better decisions with the data. In my view here, I have 8,000 reports that people are reading this week. I've got new leads that have converted. I've got 16,000 reads on the emails this week. It's a really like people care about what's happening in the market and they want to hear it from you. What I'm looking at here is the Altos is the advanced analytics page, and we were just looking at price decreases. Now I mentioned that we're down to 32% of the homes have had price cuts. In some of the country, it's more than that. Um, the Florida markets, Indianapolis is tops of the country right now in with price reductions, and you can see a slower market than last year. Um, what we have in places like Texas, like Austin, in the 22 market, as the rates rose and the market slowed way down, you could see as many as 60% of the homes on the market in Austin had taken a price cut. That's down to 42% right now. It got as high as 52 this year, not as bad as last year. So, and Austin is one of the markets that recovered less quickly than many of the other boom markets. So right now we can see the Florida markets at the top of price at the price reductions, meaning they're the most slow markets. But in the 40s, many places in the 40s, especially investor heavy markets, it's pretty common to have 40% ranges. 30 to 35 is common for the national. In some of, for example, the real high demand California markets where inventory is chronically short, the price reductions are more commonly closer to 20%. But in places where inventory is bigger per capita, like the middle of Texas, it'd be 42% is not an uncommon number of price reductions to have in a place like San Antonio. So what this is telling us is you can see regional areas of slightly slower, and I also, mentioned inventory is higher in Florida than last year. Inventory is higher in Texas than last year. Um, Arizona is just about to its last year level of inventory. So you can see where the regional slowness is happening. In the advanced analytics I built, like I'm interested in watching, for example, Austin over the last 10 or 15 years. And this is inventory. And you could see this summer, inventory in Austin was higher than it had been anywhere in the last decade. Right now, you can see we have 6,700 homes in Austin, 5,700, up from 1,000 during the pandemic, less than 1,000. So really big changes. I have this chart of Dallas, and I'll do a Dallas local report in just a second here. This is Dallas inventory now. This is 2023 versus the pre-pandemic years. And you can see that at the end of the year, Dallas inventory is getting finally close to where it was pre-pandemic. Texas in general is getting there. And it's, I think, a notable time. All right, let's move to some local market reports. This is the Altos report. I have Boston up here. I thought I'd start with Boston today because we can look at the other side of the coin, which is how much of the country we're still at pandemic lows of available inventory. In fact, there is 2,100 homes available in fact, I can do this little view right here and zoom in, and in Boston. So 1,500 homes on the market right now, less than last year at this time, just barely more than the beginning of 22. So really a fascinating, much tighter market than, say, the Texas markets are right now. You can also see in the Altos reports, we use each market, we look at price range segments. The high end of the market may be behaving very differently from the low end. And in Boston, the high end is almost $3 million, 90 days. But look at this down here at the $500,000 homes, 28 days. Like that's a market that's moving. And if you have buyers and sellers who are sitting there going like, well, I know that the house down the street had like it was on the market for 3 months and they did price reductions, and you say yes, but we're looking in the $500,000 range. These things are moving in a few weeks. Like if you want this house, we need to make an offer now. And that's how you can communicate where that the specific level of demand. Austin, let's switch from Boston to Austin. In Austin has been a much cooler market all year. Um, and one of the things that happened with Austin, Texas, is that home prices did not seem to find a bottom last year like the rest of the country. It still felt like inventory was climbing, price reductions were high. Much of the year, Austin led the country in price reductions. And what I can see right now, if I look at the median price curve over time, we can see that our January 22 through the first half of 22, before the market started slowing way down, this year, the May peak, was significantly lower than a year earlier. But what I could see now is, as of this fall, it looks like the Austin home prices have found their bottom. Home prices are a tad higher than they started in January of last year. And so we can see that um, the price reductions have gone from in the 50s down into the 40s. And so you can really see that there are in slightly like we have a floor on demand. We have buyers who want to buy it at these prices. And so we can just start to see it. And so it looks to me like Austin has hit its turnaround point and will have a slight growth year. You can still see much slower time on market, no matter what the price range is. Remember, in Boston, it was 91 at the top, and it was 28 days at the entry level in Boston. So it's 70 days in Austin, Texas right now. And so that's a big deal. So obviously not a hot market, and probably still one of the slowest in the country, but I'm going to watch that. I expect the days on market to decrease in Austin, Texas this year. And while inventory is a little bit higher, we seem to have found the bottom of the price for the year. I just got a few more minutes. I have Dallas open too. And the thing about Dallas is that we are now, if you compare to where we were, there's 15,000 homes on the market in the whole Dallas, and that is basically exactly where we were pre-pandemic. Before the lockdown happened here in May, April, and that's when inventory started plummeting. But so we are basically at where the old normal levels of inventory in Dallas. And a little bit faster market at the entry level prices in the Dallas metro. But really, like, it's Texas finally getting us back to pre-pandemic levels, even though the whole country is not. I have let's just do one more. I just have Virginia Beach up just for kicks. Virginia Beach is a much more affordable market than some of these others that we've been looking at. And you can see home prices over the past few years. Virginia Beach is easily at its peak home prices, record home prices. We can see that if we switch this guy to inventory for Virginia Beach, we're still at pandemic lows of available inventory. We can see down here that, especially at the affordable entry level, the homes are moving very quickly. Higher end Virginia Beach is slower, so that's true across all these markets we've looked at. And so you can really see why there is the support across the country for home prices, for slight appreciation of home prices. You can also see that there are people who are still expecting a big flood of inventory that's going to bring an imbalance, and that home prices are going to crash. And you can see how tight inventory is still in so much of the country, even while some of those places in the South, Florida and Texas, are back to normal levels or kind of normal levels. There's still no sign of any big flood of inventory. All right, those are the local markets. Let me just do a quick share back here and wrap up here. As I mentioned at the beginning of the talk, if you're sitting here and like, we can't get to all the local markets, but if you need to get to your local markets, you can book time with our team. Go to the Altos Research. There's a link in the chat. Go to Altos Research, book time with our team, and make sure you talk about how you can use the market reports Okay. You talk about how you do your market data in your listing presentations, take your reports to your buyers and sellers in their email inbox every week because the market's changing quickly and everybody wants to know what's going on. A lot of people still think the market is tanking like it was a year ago, and they are afraid. So they need to have the real-time data right now. The free Altos ebook to learn how to talk about the data, the scripts, when to use it, ideas of what to say, strategies for how to help people understand about the using market data in your business. All right, that's all the time we have for today. I appreciate it as always very much. The webinar is recorded. It'll be in your inbox today. Watch for that. And as always, we'll be back next week with our weekly video. Thanks, everybody. I'll stick around in the chat to make sure we have all the any last questions answered. Thanks, everybody.